Hello, all you lovely people out there. How are you all doing? I'm Kate Hill, and I am here to give you the best commentary about our property markets. Tina Howes is with me from SmartMove, one of Australia's leading and award-winning mortgage brokers. We are giving you a whole series explaining all things property finance, so stay tuned. Hello, everyone. Tina and I are back, continuing with our series about all things property finance. And today we want to talk to you about being self-employed. There can be, I think we found two different myths out there when it comes to borrowing money when you are self-employed. Some people think that the banks treat you absolutely no differently. They sort of just march on in there and assume that everything's going to be as it would be if you were on a salary. And some other people think that it's absolutely impossible to borrow money and don't even bother. So Tina and I want to discuss this. Just to, I guess, generalize a little bit as part of our introduction here, that on the whole, the banks do not look upon you unfavorably as a self-employed applicant. Is there more due diligence? Yes, absolutely. Is there more paperwork? Yes. Tina will elaborate on all this shortly. Is it more complex? Definitely. Will your approval take a little bit more time? Most likely. But will they frown upon your application? No, definitely not.
Well, Kate, they may, but not for the sole fact that you're self-employed. There may be other elements where they
might just not like the look of me, right?
Yeah.
So let's launch in, Tina. Tell us a bit about your experiences and lead us into this.
I think you and I started chatting about this topic when a week ago I had a client that said to me, look, I'm self-employed. I just think the banks are going to look at me negatively. So it's best that we just leave me off the application. And it got me sort of thinking that how can I dispel that perception? Because the reality for this particular client was that if we didn't include her income, which admittedly was a small proportion of the whole package, compared to her spouse that was PAYG, but it did actually reduce their borrowing capacity, in particular because we had no income for her, but as a household, we had all of the expenses being funded and being maintained by that one applicant. So that was kind of the gist of it. And I guess if we sort of look through and break up self-employed, there's some real key points that I think are worth mentioning so that you go in fully aware and fully understanding of what's involved.
Yes. So, let's go through those sort of main pointers. I think the first one is paperwork. There's a lot of paperwork anyway, right? Let's not pretend there isn't.
Look, there is. There's no doubt about it. We like to think that there's less and less paperwork these days, but if you're self-employed, you need to be prepared to be providing your tax returns, financial statements, tax assessment notices, potentially BAS statements, depending on the bank. But essentially, if you're PAYG, you're usually limited to a couple of pay slips, tax assessment notice, or group certificate equivalent. But even if you're self-employed and draw a PAYG salary from your company, if you are a director and shareholder of that company, then the bank is going to ask just to make sure they can see what the financials of the business look like and make sure that that income that you're drawing is sustainable. And that's kind of the key point around paperwork.
Yes, and I think it's always good to bear in mind, just coming back to what you just said there, that the bank is, and quite rightly, always risk assessing, right? So you're being assessed as a potential risk. They're going to lend you money. They need to assess what risk they are taking by lending you money. So
absolutely,
that's putting it very crudely, of course, but that's essentially what they're doing. So you do need to expect to provide all of those things, and there are just obviously slightly different things to if you are on a salary. So talking about tax returns, BAS statements, how, sometimes people get to a certain time within a financial year, at what point will the bank need last year's financials, if you know what I mean, as opposed
so,
to the
we're in late November 2021 now. Most people have done their 2021s, but you're not obligated to do them until sort of May next year in 2022. But typically that turning point, if you want to have access to the majority of lenders out there, come sort of February, you want to have your 2021s done. I am telling clients now, particularly as we come into that crossover of Christmas with, shutdown periods potentially. If you want to have a pre-approval that is valid beyond that first sort of 3 months, and, it might take you a little bit of time to find that property, then you really want to be assessing those numbers on the 2021 figures. Otherwise, you run the risk that by the time you've lodged your 2021s, they might be different to 2020s, and it's a completely different situation.
Okay. Our next little header here that we talked about is profits or income.
So this is a big one. Often I will have people come to me and say, okay, we want to buy a property, so we're going to start to pay ourselves a higher salary. Will that mean we can borrow more money, Tina? And the answer to that is, well, no. If you've all of a sudden started to draw more money out, the bank will still look at the historical performance of the company, and they'll look at your 2021s and your 2020 performance, and what salary and wages were drawn in that year, as well as whatever the profit was and the dividends were. I would strongly suggest, it does come up a bit, should we be paying higher salary, lower profits? I would say go with what your accountant is saying from a taxation perspective. If it means that it's in your interest from your accountant's perspective to pay a lower wage and draw higher dividends, or just leave that money in the business as a profit, as long as you own the business outright and you're 100% owner, the bank will essentially treat it the same whether it's wages or profit, as long as there's that history there.
Yes. Okay. So segueing on from that, what if you don't own it outright? What if you are a part owner?
Okay. So it gets trickier. And particularly if you're a 50% owner, you're going to find more lenders that are prepared to include those profits. If you are less than 50% and the other business partners are not related to you, then you're going to find it harder to be able to rely on using those profits if there is no history of the dividends being paid out. Okay. So as a general rule of thumb, in the past, if you have paid dividends and drawn that profit out, and you're only a 30% shareholder, then the majority of banks are happy to look at your last tax returns and go by whatever distributions have been made. But it does get harder when you're only a 50% or less owner and you haven't got that history there. You're going to find less lenders that are prepared to actually use your profits because there is no history there to suggest that you will actually pay out a dividend and can use that cash, that the business isn't using that for its working capital or growth needs.
Yes. Okay, so we've talked about profits, we've talked about income. What about losses?
So the bank is going to want to understand why there is a loss in the business. Was there a one-off anomaly that created that? And, if you've been paying a large wage, but the business operates at a loss, then the bank's going to need to factor in as though that loss was ongoing, and how does that loss impact upon the wage that you've drawn? So, hypothetically, if you've drawn a wage of $100,000, but there was a $10,000 loss with no explanation behind it, then that $10,000 loss is going to need to be factored into your equation and potentially only use a $90,000 income instead.
Yes, that's right. Yes. Okay. So, which is obviously slightly different to, let's say, if the business has debts.
So debts are something that the majority of lenders, if there is debt in the company, because you're on the hook and more than likely provided a personal guarantee for that debt, we're talking overdrafts, commercial property loans, car leases and so forth, credit cards, the bank's going to want to factor in those debts into the overall equation, as well as obviously factoring in the profits. Where you are only, say, a half or 50% owner of the company, most banks will actually include 100% of the debt because you are jointly and severally liable for that level of debt.
Yes, I know.
So it can really make the numbers a bit more challenging in terms of borrowing. There are a handful of lenders that will actually exclude those business debts. they're fairly limited in those lenders though.
Yeah. Which, I mean, in a sense, when, you know, again, in my sort of slightly crude way of looking at things, is really no different to having, say, a $20,000 credit card, which you only use maybe 5,000 of, but the bank has to assume that you could literally go tomorrow and spend all $20,000, right?
Yeah, look, company debts are a little bit difficult because, you know, generally your ongoing working capital is going to fund those. So if we took the complete negative perspective, then, you know, you could do that across everything and you'd never be able to borrow money.
That's
but
yes.
Case by case, you know, if a client really needs that borrowing capacity, then I'm all for those lenders that are prepared to put aside business debts. And it's important to note those particular lenders are also not going to include profits if you're only a 50% owner of the business, unless the other 50% is your spouse. And they will only use profits that have been paid out as dividends. So
so there's obviously a lot that they're looking through that's being, you know, assessed. Talk to us about turnaround times.
Okay.
To pre-approval, and then I guess also the purchase when it happens.
So obviously there's a complexity involved with self-employed. You need to have the ability to understand financial statements, profit and loss statements. A lot of business owners themselves can't interpret that. So whenever you're getting to an element that is more specialized, then it needs to be a more experienced bank officer or credit assessor. And obviously more expertise means there's less of them. So the turnaround times are going to generally be longer to assess a self-employed application because it's just more complex.
Yes, so people just need to factor that in, right?
Yeah, there's one bank at the moment that are, you know, they might only be 2 or 3 weeks for PAYG, when I say only, but it's 6 weeks for self-employed.
Yes. Is that for the pre-approval or for the formal approval?
Look, largely pre-approval. Timeframes get a little bit better when we've actually got a contract with a deadline. But even then, there'll be certain banks that I'm like, we cannot make that 42-day settlement with that lender for self-employed. Sorry.
Okay, so what I'm hearing from you, certainly over the last few minutes, is that not all lenders are the same, which we all know. Anyone watching this series will know. So they're not, are they? They're all assessing differently with different criteria.
Different self-employed add backs, 1 year's financials versus 2 years financials, BAS statements, no BAS statements, COVID payments included, COVID payments excluded. So many variances. Yes.
Okay, so to conclude, what is our upshot here? I think we're saying sort of please don't just automatically be deterred because you're self-employed. Make sure you have a really, really good broker. Right there next to me, who understands this sort of more complex lending and knows how to read financials and has a good understanding of how businesses work, right? But don't make the assumption that you can't borrow money, but equally don't just leave it to the last minute thinking, I'll easily get a pre-approval.
Get your ducks in order, make sure that your financials are all done, your ATO debt's all paid up. And just give yourself enough time to get that pre-approval.
Yes. Great. Any other moral of the story? That's it, really, isn't it? Yes.
I think we've covered it, Kate.
I think we have. Thank you so much, Tina. It's really appreciated. We will continue with our series on property finance very soon. So we will see you all again.
Great. Thanks, Kate.
Bye.
Bye.
I really hope that you found all of that useful. Tina is a mind of information. She and I will bring you lots more videos explaining all things property finance. Don't forget to leave us a comment and a question. And don't forget to hit the subscribe button and also just give us a little like on the video if you are enjoying the free content. And we will see you really soon. Bye.